Welcome to the first ever episode of the Seeking Value podcast. I've been super excited to launch this for a very long time now, and I'm even more excited to have a great guest here for the first episode of the podcast. So today I'm going to sit down and chat with Investing with Tom. If you're listening to me, I'm sure you already know who Tom is, but if not, you can go and check him out on the Investing with Tom YouTube channel, where he has over 30,000 subscribers, or you can go and listen to the Investing with Tom podcast as well, both of which I highly recommend. Tom is a big reason why I went out and started my own YouTube channel. He was one of not too many creators on YouTube that was putting out really quality investing content. He was also partly an inspiration of why I wanted to start this podcast as well, so I can't think of a better first guest to have. In the conversation, we're going to jump into some of Tom's biggest holdings in his portfolio. We're going to talk about Seritage Growth Properties, Alibaba, and Thor Industries. These are three really interesting companies, each with their own appeal. And in this podcast, I'm getting Tom to break down each of those different companies and kind of have a back and forth about some of the different aspects of the businesses. Just before we jump into the conversation, we do have a sponsor here on the podcast, which is Sharesight. Sharesight is an amazing portfolio tracker that helps you track things that you can't track in a spreadsheet, like currency gains and losses as well as dividends. It's the one-stop place to track your overall returns in your portfolio, and it makes things like tax time a lot easier. If you want to try out the Sharesight service, you can use the link www.sharesight.com/investingwithfrank to get 4 months for free off your first 12-month subscription. Or you can also go down to the show notes and you can find that link down below. Or if you're watching on the Seeking Value podcast YouTube channel, you'll find the link down in the description as well. Now let's jump into the conversation with Tom. I hope you guys enjoy. The Seeking Value podcast is for educational and entertainment purposes only. Nothing in this podcast should be used as financial advice. All right, thanks for coming on the show, Tom, and being the first guest on the Seeking Value podcast. Just to kick it off, could you give everyone a bit of introduction about what you do and then maybe jump into your investment approach as well?
Yeah, sure. I'm excited to be the very first guest on the podcast. Do I have to fight anyone for this privilege, or was I just top of the list somehow?
I'm not going to lie, I've reached out to about 5 or 6 and they're all scheduled, but you're the first one to organise a time, so.
Okay. No, that's cool. Yeah, I appreciate you having me on. I'm looking forward to the podcast. I follow a lot of what you do, obviously. So, yeah, I run the Investing with Tom YouTube channel and podcast for anyone that hasn't come across me before. I started investing probably about 4 years ago now, kind of just started a first job out of uni, had a few $1,000s saved up and was trying to find a home for that, and wasn't in a position to do what the average probably Australian or New Zealander does, which is try and buy property. So that sort of led me to the share market, we call it here, or the stock market, and eventually went down kind of the rabbit hole of Warren Buffett and value investing and so on, and started talking about that on YouTube. So that's, I think, how we linked up.
Yeah, so I started following you, I think about, it must be at least 2 years ago now, because I've been doing my YouTube channel for about a year and a half. A big reason I started my YouTube channel was watching guys like you, Hamish Hodder, Brandon from New Money YouTube channel as well. And then, of course, if people don't know listening, which would be surprising, we all do a podcast called Punch Card Investing, or a YouTube show, I guess it is, more than a podcast. So me, you, and 3 other guys do that as well. But I'm sure anyone following me follows you already, so they probably don't need much of an introduction.
Oh, there might be a few people out there, that Australians that love accounting businesses, that follow you and not me or something. But, I think we've probably got a fair bit of overlap.
I think so. So do you want to explain your approach to investing? Like, what type of companies are you looking for? How are you kind of structuring your portfolio and anything like that?
Yeah, sure. I guess I kind of start with sort of a value lens. So my approach is always just to try and identify good businesses available at attractive prices. And I'm fairly flexible in how that actually looks with particular companies. So I have read a lot of what sort of Monish Prabrai kind of does, or particularly in his earlier years with kind of the 50 cent dollar approach, buy a dollar for 50 cents, and if it comes back to fair value in 3 years, you're compounding at 26% a year. I even got the shirt on from Brad today, so that's something I'm still pretty interested in. But I guess the ideal portfolio really is being able to buy a lot of kind of great businesses, or enough to where you feel you're kind of diversified enough to sleep at night, but not over diversified. So that's sort of the ideal portfolio, I think, would be to try and find long term kind of compounder type businesses if I could. The trouble, I think, is that most of the great businesses out there, particularly the larger ones, don't get probably cheap enough for me to be interested. Um, all that often, unless there's some sort of broad market event happening. So I guess to fill in the slots where I haven't been able to find like enough of these long-term compounders to fill a portfolio up, that's where I sort of revert back to the 50 cent dollar type approach.
So, in a market like we're in today, where are you finding more opportunities with 50 cent dollars or long term compounders? And how is your portfolio kind of split between the two?
Yeah, I would say right now it's probably split pretty evenly down the middle. I would say it really depends how you want to categorize some of these things. Like I've got, Alibaba, for example, which I'm sure we'll talk about. I've got a company called Thor Industries, which I sort of put both of those in the long-term compounder type bucket. And I've also got more special situation and asset plays like a Seritage growth properties, which I'm sure we'll get to as well. So I'd say it's a pretty even kind of 50-50 split actually at the moment. And that isn't intentional. Like I'm not looking at current market conditions and saying I think I need to be half and half in each bucket. It's just kind of looking at each opportunity as it comes along, and if I think something makes sense, then adding to it.
Okay, so you've just named the three companies I actually want to talk about in the podcast today, so that's
Sure.
perfect. I want to start off with Seritage Growth Properties. It's a company that I actually bought as well, probably a bit over a year ago now, I would say, and I sold only a month or two later just because I kind of furthered my understanding. The thesis that I had in my head, I didn't have the same level of conviction, and I did sell out. But a year later, the share price hasn't kind of moved. I lost about 5 or 10% of the position, and it's still about where it was when I sold the shares, around $14.50 or so. It might be even slightly lower. But regardless, it's about the same. It's kind of gone sideways, and it's starting to get a little bit more interesting. Did you want to give like the quick pitch of why you like Seritage, kind of what made you get interested in the first place?
Yeah, I think I got interested for probably many of the same reasons you did, with seeing Monish Prabrai buy into it. I had actually seen it in 13Fs before because Guy Spears owned Seritage for quite a few years. I think he bought into Seritage when it was this a bit of a wide range, but maybe somewhere between $30 and $50 a share, and it dropped all the way down to I think $5 a share in the depths of the sort of March April 2020 crash. And as far as we can tell, Prabrai probably got in at um, I don't know, somewhere in the $7 to $9 range, something like that. That's a bit of a guess because prices were moving pretty wildly at that time. But yeah, effectively, Seritage is a real estate investment trust, a REIT. So they own effectively all of the real estate that used to be Sears stores before Sears went bankrupt. It got spun out into a separate entity, which is Seritage, and it's not it's not sort of the traditional REIT, I guess, that prints a bunch of cash flow from all these, fully rented out properties and pays fat dividends. I think that's where um, Seritage will end up eventually, all going well. But right now, it's very much an asset play. So you can kind of assess the value of the Seritage assets. You can subtract out the debt, and depending on what sort of real estate values and things you use, you know, you can arrive at pretty substantial discounts to net asset value.
Okay, so real estate companies in general, I was reading through a Seeking Alpha article on Seritage just the other day, kind of prepping for this interview. Most real estate companies, REITs in general, are up about 20% from their pre COVID prices. The real estate market's gone pretty crazy in all aspects of real estate as well. Seritage is down 40% over that time period. So they kind of dropped off during COVID, like everything else. It did rebound a little bit, like it got hit. I think it went from $40 a share down to, like you said, $5 or $6 or something like that. It has rebounded, but still 40% lower than their pre-COVID price. What's kind of the reasoning behind that, and what makes you think it's going to recover, I guess?
Yeah, I don't know. I try to not spend too much brain power on trying to explain why stock prices might be moving around a bunch, but I think there was a real risk in March and April last year that Seritage could have gone bankrupt. They have a lot of debt, and they're burning cash. If you look at their financial statements right now, they don't look all that pretty. And the main reason for that is because they're going through this big redevelopment kind of process. Like I said, these are all ex kind of Sears stores, and they're needing to repurpose these properties for new tenants. And there's sort of a couple of things that come with that. Obviously, that's quite a capital intensive sort of exercise to spend a bunch of money on repurposing real estate. But the returns look really attractive. So, they're taking real estate that was previously rented out to Sears at maybe $5 a square foot, and they're getting like 4 times the rent per square per square foot on some of these properties. On average, they've been going to about $20 a square foot. Some are a little lower than that. Some I've seen as high as $30 a square foot. But that's kind of one part of the investment thesis. The other part of it is they're basically selling off properties that don't look all that attractive for redevelopment. So where the returns on capital aren't that interesting, they're selling that off and kind of deploying that cash into these redevelopments. So um, that's of interest to me. And yeah, I think if they can kind of pull that off, and we've starting to see pretty good signs and a bit more clarity on how that might look. I think if they can get out the other side of that, you got some nice kind of cash flowing properties.
Yeah. So I guess what I'm kind of getting at with the share price is there's a lot of short interest in the stock, which I'm not sure at the percentage wise of it at the moment, but it's relatively high. One of the most shorted stocks on the market. If I was to assume why, I haven't looked too much into any direct short thesis on it, but it's mostly related to the debt. I would say they have $1.6 billion in debt to Berkshire Hathaway,
Mm-hmm.
and they're paying, I think it's 7 or 8%. We'll go with 7% interest roughly, which is super high to be paying on a large amount of debt relative to the size of the business. And of course, that leads to a pretty excessive cash burn. I think cash burn's around $100 million a year or so. That might be slightly off, but that's roughly what they're paying in interest expenses and everything else as well. How are you thinking about the debt, and like what do you want to see happen with that debt long term? Because obviously it's probably not great if they keep paying 7% interest over the long term.
Um, yeah, I mean, so the debt is 1.6 billion. They've actually got an additional 400 million they can potentially borrow if they hit certain kind of net operating income targets, and it is 7% interest on that debt. They actually pay 1% on the 400 million they haven't borrowed yet. So um, that's a kind of kicker that they add on top, and all of that debt is actually from old Uncle Warren at Berkshire Hathaway. So um, yeah, that in some ways that's very expensive debt, or in many ways that's very expensive debt. But in other ways, Berkshire's quite a nice lender to have. They're probably the last people that are gonna drag you through bankruptcy court when a March 2020 kind of does happen. So that's kind of my view on what the debt kind of situation currently is. But Andrea Olshan, who's the relatively new CEO at Seritage, has come out and fairly openly said that they do want to get away from that Berkshire debt kind of over time. And we had a press release just, I think, in the last week, maybe, or last couple of weeks, out of Seritage saying that they've come to an agreement with Berkshire on extending the maturity date on some of that debt. So initially, all of that 1.6 billion was due in, I think it was July 2023. They've now been able to kick the can down the road 2 years. So they've got half of that loan, 800 million due still in 2023, and 800 million due in 2025. So I think over time, or at least before 2023, we're probably going to see the debt move to more of a kind of property level financing rather than the overall kind of Seritage banner. And I think market rates for the types of properties that Seritage own are sort of more in the 4 to 5% interest range. So, Seritage has a lot of debt, and even that, couple percent maybe saving on an interest rate adds up quite a bit for Seritage.
Yeah, so part of the reason I sold out at the time was that debt and how high it was. But at the time, there was a changeover of management. The CEO had left the company. There was kind of no one at the head of the company. And my long term thesis was kind of that eventually they can refinance this debt, whether it's through Berkshire or some other lender, and get down to around the typical 4 to 5% range. 5% was kind of the number I was looking at because the adjustment towards net operating income, if they could do something like that, it would get Seritage back to an impressive level where they're going to start paying a dividend. They're actually profitable. But at the time, I couldn't see that happening because they had no management team kind of heading this. It looked like everyone was trying to get out. Then Andrea Oshlan, I'm probably pronouncing that wrong,
Andrea Olshan.
stepped in. There you go. Stepped in as CEO. What have been your thoughts on her so far?
Yeah, I had pretty similar thoughts initially with a lot of management turnover. That was definitely a red flag that didn't lead me to sell at the time, but it's kind of like, we better be laser focused on this and kind of see what happens. Yeah, so Andrea Olshan's background is from like a family real estate business, Olshan Properties. Her dad, whose first name I'm forgetting, has quite the sort of real estate empire, really. And when you sort of start doing some Google searches on Andrea Olshan and that sort of thing, there isn't a whole lot of career history that you're able to find outside of just the family business, which I mean is fair enough if you come from a very large family business. But she did an MBA at Columbia, I believe. But this is kind of her first gig as CEO, kind of outside the family business. So um, initially, after Andrea Olshan got in there was kind of more management turnover. So sort of the C suite had a bit of there was a bit of culling that kind of happened at headquarters and that sort of thing. Um, but since then, I think it's been really positive. Like we've had a lot more clarity on how they view the portfolio. They've been much more open about what they intend to do with the debt. In the last month, even they've given us this full list of properties for the entire portfolio, and they've said these are going to be retail, these are going to be, our premier developments. These properties are going to be, you know, like multifamily housing, basically. And these are all the other properties that we're likely to sell. So that gives a lot more clarity from a valuation perspective. And I think things are just kind of happening a lot faster now. So from my perspective, it's been very positive.
Yeah, so she's probably a big part why I started to look into the company again, and I'm getting pretty interested. I haven't done a lot of research again, but from what I understand with her is she had every opportunity to stay in a very successful family business. And I guess all the people that are shorting Seritage would think she jumped onto a sinking ship. But obviously, she's seen some kind of turnaround play with Seritage. Otherwise, why would you leave a successful family business? And the one thing I liked about her is like the thesis that I guess we all kind of had with Seritage early on with the previous management team. They hadn't been clear that that was what they were going to do, whereas Andrea has kind of set that out step by step. What properties are they going to get rid of? What the property is going to be worth? And yeah, I think she's done a good job at kind of outlining to investors what they're actually going to do.
Yeah, and I think the broader management team have been quite open as well. I'm blanking on the CFO's first name, but her last name is Lombard, I think. And she's had investor calls with people like Matt Peterson, who I had a mic podcast a couple of weeks ago. And Matt's like literally going through property by property. This is what I think this one's worth. Does it seem kind of reasonable? And just helping him go through and say this one's a little high, this one's a little low. Um, but on the overall portfolio basis, I think he was roughly in the right areas. And yeah, we've seen Andrea Olshan interviews when she's come out and said, cash flow today, we're not your girls. We're sort of a we're sort of a net asset value play. But obviously, the plan is to turn those assets into cash flowing machines over time. So yeah, we're starting to get a lot more alignment with what maybe we were thinking like a year or 18 months ago. We're starting to see that come to fruition.
Yeah, okay. What about someone like um, Matt Peterson? Does he have an approximate number he's thrown out there publicly,
Yeah,
or
Matt Peterson in his annual meeting put out that he thinks Seritage in 2025 is going to be worth $35 a share. Um, there was some, there was a lot of conservatism, if that's a word, I think it is, built into those numbers. He had sort of net operating income that he thought they could generate on a fully developed portfolio, but then he was going ahead and applying like 7% cap rates. So um, on the types of properties where maybe 5% or even sub 5% is typical. So um, that's kind of like the equivalent of um, what's the maths on that? Valuing things at like 14 times earnings when they should be 20 to 25 times earnings, that sort of thing. So there was a lot of conservatism, I think, built into those numbers. And they've also got a lot of like bare land assets and stuff that he didn't include as well. And they've got joint ventures and various other things that, there's perhaps a little more upside than that. But that's the number he's put out there publicly is $35 a share in 2025.
Yeah, okay, so do you have like an exit strategy for Seritage at the moment? Like, are you just waiting to the market kind of recognizes these underlying assets and their true value? You get a bit of a mean reversion back to the net asset value or the true net asset value. Are you going to stick around to maybe collect a dividend over the long term? Which I guess once all these properties are kind of signed and leased, they stabilize their rental, they can probably refinance their debt once they stabilize these properties. It is a slow, nice, probably not a compounder, but a nice dividend paying, safe company if that plays out. Or are you just kind of waiting for the stock price to rebound and get out?
Yeah, I mean, SRG is a fairly volatile stock, and I think there's a lot of temptation to act when that's kind of happening. Um, I'm trying to take this one as kind of slowly as I can. I think in the back of my head, I'm sort of saying, if it shot to say $30 a share or something tomorrow, in and around what we think net asset value roughly is, I'm probably a seller. Um, Once we get more clarity on what net operating income might actually be, and there's obviously a lot of like slightly more macro concerns with interest rates and so on. So maybe a couple of years out, we've got more clarity on what typical cap rates are, and once we know what the net operating income is likely to be, you can probably start to be a little more precise about what Seritage is actually worth, um, and particularly when they've got some of these like premier developments coming on, like they've got a Dallas property that Monash Provides talked about a bit, which they're not only ramping up the rent per square foot, but they're doing a massive densification and kind of building vertically and increasing the number of square feet as well. And I can potentially see, one or two of those premier developments being worth like kind of the current market cap sort of thing. So there's still a little bit of uncertainty, or there's still quite a bit of uncertainty. So um, I think once we've got more clarity on those things, I'll have to review how I think about selling. But in the short term, like the risk reward is attractive to me today. But yeah, if it's shot close to net asset value in the short term, I'm probably exiting.
Yeah, I think that's one of the main reasons I personally lean towards the long term compounder positions rather than a special situation or some type of asset play. It's just that exit strategy. I guess a long term compounder, the idea is pretty much just hold as long as possible. There's no real worrying about selling in the near future unless something dramatic changed about the company. And then I guess it becomes fairly obvious to sell. But with these more short term, quick turnover type plays, I really struggle to find that right time to sell. Do you have maybe with a company other than Seritage, is there any other good example of when to sell a special situation or something like that?
Um, yeah, I guess special situations by their nature are quite unique to each stock, so it's kind of a little tricky to give an example. Yeah, it's a tough one because I think we're in the type of market where, like, all of a sudden, everyone's biggest mistake has been that they sold something too early. So, not selling seems to have been a pretty good strategy, but I don't know if that is quite the right answer in all market conditions. So, yeah, I don't have a great answer on that, to be perfectly honest. I'm kind of comforted by people like Charlie Munger saying that, he's like 97 years old or something now, and he's still trying to figure out the right strategy for selling. So, yeah.
I was about to bring
Yeah.
that up as well. Yeah, it's selling's just one thing I've always struggled with. It's hard to know when to get out. Even when I exited Seritage earlier on, for example, I was so hesitant in doing so. It's worked out that the share price kind of went nowhere, so it's probably good opportunity wise that I put that capital elsewhere. But that just come from luck. It wasn't like I knew this stock was going to be flat. It was just kind of a random exit. So that's something I do really want to improve on
Yeah.
over time. So,
Yeah, and you
but if Charlie Munger can't do it, maybe I can never do it either. So,
yeah, and you bang on about like if you've got more interesting places to put the money, that really changes the selling equation as well. Like I think when we talk about selling, a lot of people will focus, just on Seritage and what's happening with Seritage, in that example. But you have to also think about, there's tax considerations potentially. What are you actually going to do with the proceeds of selling that stock? You're just going to leave it in cash for 6 months till you find something, or are you going to have you got somewhere more interesting to put it that you're equally as confident in or more confident in right now? Um, yeah, they're all kind of considerations that you have to make, and I don't think there's an easy answer to it.
yeah, I think that's one thing retail investors don't consider much is the taxable. If you're in a taxable account, like how much that can impact the long term compounding. Um, it's something when I first started investing, I didn't really think about too much, but yeah, it's another reason why I start to lean more towards those long term compounders that I can just sit it there and there will only really be one taxable event, hopefully not for a very long time.
Yeah, I probably need to make some videos on this, but the New Zealand situation is quite interesting because we're one of the few countries remaining that don't have a comprehensive capital gains tax. So I don't have to worry about that one too much. But we do have some interesting taxes around, like if you have more than $50,000 as a cost basis that's not in New Zealand or Australian stocks, you start to get some taxes that something called FIF tax here in New Zealand, which, yeah, I don't want to get too political, but in my view, it's effectively like a wealth tax. And I don't think many people are considered super wealthy to have 50 grand invested or whatever. But yeah, that's an interesting one just to keep in mind as well. Like to me, I don't talk about it a lot on YouTube because I'm not a tax professional or anything, but finding New Zealand and Australian stocks is actually quite a bit more attractive to me from a tax perspective. And we have tax advantage dividends just like you guys do with franking credits in Aussie. Um, we have like dividend imputation credits in New Zealand doing the same sort of thing to offset that like double tax of the company's paid tax, and then if you're a US investor, you're having to pay tax on that dividend income again personally. So
Yeah, the capital gains tax here is an absolute killer.
yeah.
It makes me hesitant towards some of these shorter term positions. Even something like the tax you have to pay on the dividends from companies overseas is just pretty crazy compared to the nice franking credits we get here in an Australian company. So
Mhm.
that's just another consideration small retail investors in Australia and I guess kind of New Zealand as well have to really consider. The next company I want to talk to, so that was, I guess, the 50-cent dollar. Now moving to the other type of investment strategy, the long term compounder. Thor Industries, which I believe is one of your larger holdings, or at least one of your better performing holdings. Is that about right?
Uh, yes to both.
Do you want to give the pitch for Thor? What kind of got you attracted to that one? What do they even do for the people that don't know?
Yes, sure. So I invested in Thor just over 3 years ago. That was actually like my first investment that I would consider like a value investment. Like I was running DCFs. I think it's trading at 50 cents on the dollar. Got a nice margin of safety. I was very much in kind of Philtown Rule One world at that time, and that's sort of the first stock I bought sort of through that lens. So yeah, I guess depending on whether you're in the US or you're down under, Thor makes RVs and trailers, or motorhomes and caravans, depending on what you want to call them. They're a wholesaler of those, so they don't own any dealers or anything like that. They sell to the dealers, who then go on and sell it to a person that wants to go travel around in one of those things. And they were started, or at least they went public, I think in the 80s. And since then, they've kind of just steadily been acquiring other RV and trailer brands. So they've got a huge long list of them. You can go on Thor's website and kind of scroll through like a timeline of all the acquisitions that they did. Um, and yeah, I mean, it's got a very, very good history, like returns on invested capital and kind of the 20% sort of range. I think if you'd held the stock since IPO, you might have compounded at 12% plus dividends, maybe something like that. But it is a cyclical business, so it's never going to be one of these stocks that trade at 40 times earnings or something. If you look at the earnings of the company and the stock chart, it is kind of a bumpy ride over time. But I think that also gives value investors like the opportunity to buy in when they are kind of having tougher years and that sort of thing too. So, um, yeah, I like it. I like the position. They're firing on all cylinders at the moment. They have like this ridiculous order backlog, which maybe we can get to, where typically they have anywhere from like $1 to maybe $4 billion in order backlog. So dealers, making orders with Thor, and they've got this backlog of orders that they're trying to work through and produce for the dealers. Um, so yeah, maybe 1 to 4 billion typically. Thor's annual revenue only a couple of years ago was maybe 8 billion, and they've currently got a backlog of, I think they just reported earnings on Thursday, and the backlog was like $18 billion. So that's yeah, just insane demand at the moment. Which management have come out and said that'll take us a year at least to work through the current orders. So kind of a crazy situation they're in at the moment. But yeah, that's Thor.
And so Q4, which I guess is the earnings we're just talking about. Again, I haven't looked into Thor much. I kind of just dug in a little bit before talking to you today. They beat their earnings per share expectations by about 30%, which is pretty insane. But is that more of just I guess, future sales being pushed forward because there's all these international travel restrictions with COVID happening? Is that going to slow down the long term growth? Or is that more great business operations by the management team and something that can be sustained over time?
Yeah, this is a huge boom. I don't see this being sustained for multiple years. They're going to have like a year's worth of revenue kind of just sitting there, you know, ready to go. But at the same time, like demand has just been crazy. I mean, you can probably imagine that when people aren't allowed to travel internationally, they start to look at local travel options a lot more, and that's been a big tailwind for Thor. Um, that had kind of general tailwinds and kind of positive trends towards RVs and things being more popular already, and they've done things like bring out cheaper options to have younger people in like their maybe late 20s or 30s. They had product options that those people could buy for like as cheap as I think 15 or 20,000 US dollars. They could buy a small trailer, and then they've got the Tiffin, which is a brand they just acquired in the last year. Tiffin motorhome that goes up to like 900,000 or $1 million. So they've got like a huge
Wow.
range in product pricing. But they'd focused on the cheaper products to try and get people into those vehicles earlier, because what the typical kind of lifetime of a RV owner is, traditionally maybe they bought one when they were 35 or 40, and maybe they get a new one every 5, 7, 10 years, something like that. But they've got people starting a lot younger, and I think that's been a nice tailwind for them. But yeah, I can't see the current boom lasting forever. It's almost a certainty that, that they'll go through a down cycle again. But that's just kind of the nature of the business, and I think you got to normalize these earnings a bit when you're trying to analyze the company.
Do you have any idea what their market share is? Firstly, are they only operating in the US or are they international? And what's their market share towards someone like a Winnebago or their other competitors?
Yeah, I don't know Winnebago off the top of my head, but Thor has about 40% market share in towables, and about I think 48%, something like that, market share in motorized. That's in the US, and I forget the stats in Europe. But when I bought into the business, they had just done their biggest acquisition ever, which was the Erwin Group in Europe. So they went from almost no European business to like a 1/3 market share. Actually, I think it is in Europe. They kind of did that overnight with a really big acquisition. So
Wow.
yeah, that's sort of their current current layout. And since they do have such a big market share, I think they're probably not completely at the end, but I think the acquisition opportunities will certainly slow down over time. Um, there's only so much market share you can take until you can't acquire any more businesses. So it'd be interesting to see how they kind of allocate capital moving forward. I think we're probably pretty likely to see share buybacks get turned on at some point, and they've actually started acquiring a few kind of smaller parts businesses and some other things where Thor is pretty much the sole customer of those businesses anyway. So it seems to be kind of a nice fit too.
So, do you know the kind of revenue split between the US or North America compared to Europe? And like, where's their future growth going to come from? Is it going to be price increases in the US or is it to expand geographically
Mm-hmm.
overseas?
Yeah, I don't know those exact numbers off the top of my head, but I mean the it's it's a little bit like your KPG investment, I guess. They're in quite a slow growing industry, like probably grows maybe slightly faster than the rate of inflation if you look at just RV registrations over time. And they've grown historically just through making acquisitions. So um, average prices are definitely going up, and we've seen that a lot because there's huge demand right now. Average prices are going up. Gross margins, I think we're up from maybe something like 14% to 16%, something like that. So um, there's a lot of concern out there at the moment from supply chain issues and so on. But Thor are kind of having zero trouble passing those costs on to the customers. So um, yeah, I think there'll be a little bit of organic growth. They'll acquire businesses opportunistically. Like the founder still sits on the board and owns, I think, something like $200 million of the stock. So he's kind of still sitting there watching these capital allocation decisions. And it's a volatile stock, so I do see them maybe turning on share buybacks at some point rather than looking for acquisitions.
So currently they're trading at about 9 times earnings. I don't know what that looks like historically, but Winnebago, for example, which I assume is their biggest competitor or must be close
Yeah,
to
it's
it.
Winnebago. Yeah, sorry, it's Winnebago, and
Okay.
there's also another company called Forest River, which is actually owned by Berkshire. I'm not exactly sure when Buffett bought them,
Right.
but yeah, they're about similar size, Winnebago and Forest River, in terms of market share.
Okay. So Winnebago also trades at about 9 times earnings, and they traded at pretty much identical sales, EV to sales multiples as
Yeah.
well. So moving forward, is there room for multiple expansion, or is the earnings growth, and I'm assuming they pay a dividend as well,
Yep.
do they? Is that kind of the driver of returns, the earnings and dividends, or is there possible multiple expansion?
I think it's earnings and dividends. I mean, multiple expansion is always a possibility, but it's not something I'm really banking on. Yeah, interestingly, actually, Norbert Liu owns Winnebago. He bought it, I think, in the same quarter I bought Thor. Maybe one quarter
Right.
later, something like that. So he's clearly on Team Winnebago, when I'm on Team Thor. But yeah, I don't see a lot of multiple expansion. Yeah, it's earnings growth, and I guess they've consistently increased the dividend over time as well. That's where the return will come from.
In your investment approach more generally, I guess, how much do you look for some type of multiple re-rate, or are you really looking for those strong earnings and the additional dividend is always an option as well?
Um, Yeah, it's interesting. Like I know, I think it was you actually introduced me to this concept of like the Davis double approach, where you look for, what drives return, whether it comes from earnings growth or multiple expansion or dividends. I've always been just a DCF guy and have sort of said, you know, I'm buying a business for. In the case of Thor, I think the market cap was $3 billion at the time, and they'd just earned, I think it was $400 million for that year in 17 or 18. And that 400 million is a very good yield on the current market cap, but they've also just had a very good year. I think it's likely to grow over time. It'll be lumpy, but as an owner of the business, I'm going to get some yield, and it's kind of up to management, who I trust, how they allocate that. So I really don't focus a lot on what like exit multiple I might get or anything like that. I try to think of myself as a long-term owner of the business, and obviously if prices shoot to insane levels, that's when we get opportunities to sell and things, but I try to not think too much about that.
Yeah, I guess the way I kind of consider it is I want my return, I want the hurdle rate to come from earnings growth. I'm not really interested in dividends typically. I'd probably prefer when companies don't pay a dividend. In my mind, it's just kind of saying they don't have other ways to allocate that capital and reinvest back into the business. That's not always true. My biggest holding pays a dividend, so it's not always the case, I guess. But when it comes to multiple expansion, I guess I want the the option for that to be additional return on top of my hurdle rate. So if I think earnings is going to grow at 20%, great. That's probably an investment I would like to make. And if there's room for an extra 3 or 4% multiple expansion each year, that's just a bonus on top.
Hmm.
But I think it's probably problematic if someone's relying on multiples.
Yeah, and I guess
Um,
yeah, and I guess maybe putting that a different way is, I want to make sure that multiple compression is fairly unlikely when you're getting into it. Um, which, yeah, I guess with Thor, I think on latest earnings that PE ratio might even be down close to 7. I'd have to check that. But yeah, I mean, is it going to get much lower than that long term? Probably not. But of course, the E part of that PE ratio is quite volatile with Thor, So yeah, that's sort of how I think about it. Try and stay away from those nosebleed type multiples, and try to stay out of trouble that way.
All right. So the last company I want to talk about today is the one that we actually both hold shares in. So Seritage I used to, Thor never really caught my attention too much. It seems like a great business, just not something I'm interested in currently. Or maybe I just need to do more work on that one. But we both hold Alibaba, which is probably the most talked about stock in the market over the past 6 months or so, or at least in the communities we surround ourselves in. I know both on YouTube, if we put Alibaba in the title, there's a lot of attention drawn to it. The comments are up, the views are up. It's just the case. So, of course, I have to talk about it on the first podcast.
It's like crack for YouTubers.
I've got to push it on the first podcast just so I can get some people listening. How do you think about investing in China in general? Like, how risky is it? Are you comfortable with having kind of what percentage of your portfolio in China or Alibaba in general? Is Alibaba your only Chinese holding? How are you thinking about that kind of market right now?
um, yeah, it's a funny one. Like if someone asks that question about the US, like how are you thinking about the US market, would both be very quick to say, well, I don't really look
Yeah,
at
you
the
don't.
US market. I look at individual companies, but I think for whatever reason, people fall into that trap with China. So um, there's a lot of stuff in China, like I don't know. There's a lot of businesses everywhere, but particularly in a country that I've never been to and don't know the culture of all that well. There's a lot of companies that I just don't think I can get my head around. I probably can't understand the competitors, but there's some larger players in that that trade publicly, like Alibaba, that I think I can kind of wrap my head around. And it's always kind of comforting to me to see super investors buy into it. That's I'm not. I'm not someone that will just clone an investment without sort of even doing any work on it, but it's like a nice kind of top of the funnel type way to get ideas. So um, I'm reasonably comfortable with Alibaba. If I'm being perfectly honest, the VIE has sort of always concerned me a little bit. It really doesn't feel um, quite as risk free, I don't think, as obviously investing in a New Zealand business or a US business. But I think the risk reward is attractive enough for me to kind of get over that mental hurdle. So, um, yeah, that's sort of where I'm at with it. How about you?
Yeah, definitely. I think the comparison you give to the US market is an important one because I would never think about how much my portfolio I should allocate towards the US. Like without thinking, I'd put all of my portfolio there if I want, if the opportunities were right. Um, Whereas with China, I kind of do have this approximate rule in my head that I don't want it to go past, say, 25 to 30% of my portfolio. I guess I haven't been really strict with that. If price rebounded and it just happened to kind of go that way, I'm not sure what I would do. But in the back of my mind, I do think I don't want to be overexposed to this market because there's so many macro or geopolitical risk kind of involved in it. And it's just, I guess, without living in China, there's no way you can really understand that market. It's something you got to grow up in. At least with the US, they're very similar to New Zealand and Australia. So we kind of get the sense of how their economy works, how their politics, all of that stuff looks like. So in the back of my mind, I know I don't truly understand that market. So I think it is important not to overexpose just because there's that additional layer of not understanding what that investment really means. And then things like the VIE structure, like you said, certainly something in the back of my mind. Another thing that a lot of the guys that are bearish on trying to bring up is the accounting fraud. That doesn't really worry me too much with a company like Alibaba. It would if I was investing in maybe smaller to mid cap companies in China, but I think it'd be pretty hard for the thousands of analysts worldwide to kind of miss some huge accounting fraud. I'm sure in the smaller aspects of the business that's a possibility, but is that another risk for you, or how do you think about those kind of accounting frauds in China?
Yeah, I guess that's one of the reasons why I'm sort of comfortable with Barber, but I wouldn't be with Luck and Coffee or DD. Just to name a couple that haven't worked out that well. Um, yeah, I mean, I sort of try and think of these things through the manga, show me the incentive, I'll show you the result kind of lens. Like, I don't see why Alibaba would have to fake anything. Like it's quite clear that you know, Ant Group's very dominant, and Alipay is used by like almost literally everyone, and it's quite clear that there's you know like Singles Day and so on are just massive events that everyone's sort of involved in, and it's getting bigger every year. Um, so yeah, I just don't see why that would even be something that people would be interested in doing. But you know, I hopefully we're not looking back on this in 5 years and saying, "Look how dumb we were."
Hopefully that's not the case. Or although at least there'll be a lot of great investors that we wrong with us. We won't be the only ones, I guess.
maybe we need to send Brett over there, Brett Kelly, and get him
Well,
into the accounts.
Brett Kelly is not a fan of
I've seen
Alibaba
that.
or China in general. I put out a thread on Twitter, just a short thread on Alibaba, and he was commenting on there. I think he said not investable or something along those lines.
I saw that. Yeah. Are you gonna try and get Brett on the podcast?
Oh,
I think he'd be a
100%.
great
Yeah.
guest. Yeah.
He's one I want on here for sure. I have
Uh,
talked to him in Zoom calls before, and I think he'd be open to that. So
yeah.
that's hopefully a future guest. And I'll have
Yeah.
to bring up Alibaba and get his true thoughts then as well.
Yeah. He's a good dude, but yeah, not a fan of China.
No, definitely not. So, with all these risks involved with an investment in China or Alibaba, I guess specifically, is valuation kind of the key factor that gets you over the line to say, okay, I'm willing to take on these risks? There's like the unknown of the cash flows in the future, like margins are thinning, tax rates are rising. There's increasing competitions with things like Pinduoduo, JD.com, Tencent. Um, there's so many moving parts and risks involved. Is valuation what gets you there to say, all right, I'm willing to take on those risks?
Yeah, I think the entire game of investing in public companies is just a risk reward equation. And Probri has talked. He's gone back on this on using something like the Kelly criterion of trying to understand the odds and betting appropriately on that. And although I don't think the maths completely applies to investing because the odds aren't known, it's not like flipping a coin or playing blackjack or something where there's sort of known odds if you're counting cards or whatever. Um, there is an element of the unknown, and I think you have to allocate capital kind of accordingly and be a little more conservative that way. But Buffett famously said, and I think people were kind of surprised to hear him say this, but Buffett famously said that he would bet on a coin flip if the odds were right. Like, um, if it's 50-50 odds and, it's a double or you lose everything, that's not particularly attractive. Like, there's no advantage in making that bet. But if it's a 50-50, bet of flipping a coin, and I'm not saying this is the case with Alibaba, but that's kind of a mental exercise I work through. If it's 50-50 of flipping a coin and, if you lose, then it goes to zero. But if you win, it's 1,000x. Then I think you'd be stupid not to allocate some portion of your portfolio to that. So, if I relate it to the other two companies we've talked about in this podcast, when I bought Thor, I thought, if it goes back to intrinsic value, it's probably a double, maybe a little more than a double, but I think longer term it could be good. And I think the downside's quite muted. So that was something I was willing to bet on. I think with Seritage, I think the assets mute the downside a lot, and you'll probably have a lot of time to figure out if that's not working out. Downside I think is fairly muted, and the upside is maybe a double to a 4x, depending on what the NOI kind of comes out at. And I think with Alibaba, the upside, long term at least, maybe even greater than that, but perhaps the downside's a little greater as well. So that, I don't know if that answers your question, but these are the things that kind of flow through my head. So I think the risk reward is sufficient for it to deserve some spot in the portfolio.
Yeah, I'd agree with that completely. Um, Valuation is certainly what gets me there personally.
Yeah.
I find it hard to believe that Alibaba's a company that the other day it was trading when it hit their low of about $110 per share roughly. I think they're about two times or 2.3 times sales or something insane, which to me is just unbelievably cheap. I did write, it was the thread that I was talking about that Brett Kelly commented on actually.
Uninvestable.
Uninvestable. Yeah. Um, I just said that the core commerce business itself should be worth four times sales. Historically, Alibaba's been worth eight times to 10 times sales for a very long time now. I know you can't rely on that past. There's been things that have changed. But to think that one of the best e commerce businesses in the world is worth less of a multiple than eBay right now to me is insane. Even with the macro considerations involved, I just think it's got to be worth more than we're looking at right now. And obviously, that's a really oversimplified way to look at it, but it just seems so undervalued that it's worth at least some aspect of the portfolio in my mind.
Mm. This
Um,
is this is something I wanted to pick your brain on a little bit, because I see you often use like sales multiples and that sort of thing, which I think I've never used a sales multiple in my life, besides maybe when I looked at ASOS and was trying to figure out, what's a reasonable margin and work backwards that way, just because they got thin margins and it's quite volatile. But I mean, can you explain like why you think that sales multiples make sense with these businesses versus like a free cash flow or earnings or some other metric?
I get, I guess every business is different, and there's always a multiple that matters more depending on how profitable a business is. I
Yeah.
guess the more likely you should be looking towards the earnings multiples and things like that. Um, and I kind of look at all of them. I think there's no real reason I go to sales multiples. It's kind of the first thing I look at. When I look at a business in general, I'm always starting at the top line. What are sales doing? How much is it growing? So when I first go to multiples, I usually just use that as my basis. Um, I guess if you're looking like historical multiples, there's less volatility in a EV to sales multiple. So the mean and things aren't thrown off. So it's just a quick way to look at a company. There's no real go-to reason that I do it. It just,
Yep.
yeah, and it really depends on the business as well.
Fair enough. So it's more like just to see if something hits you over the head and then dig a little deeper.
Yeah, yeah, that's
Yeah, cool.
about where I get
Yeah,
started.
because I was actually I've been thinking about this the last day or so. I know you're a fan of is it Andrew Rosenblum. Um,
Yeah, from Bonsai Partners.
yeah, I was watching a podcast he did a while ago with uh, a German guy on YouTube. You commented
Good,
on the
good
video.
investing
Good
talks. I think it
investing
is
talks.
good
That what it
invest.
was.
Yeah,
Yeah, and he was talking about I think Redbubble versus Etsy, and if you look at it on a price to sales multiple, or he might have been looking at some sort of like gross profit multiple or something. But there's interesting like accounting nuances, especially when you try and compare some of these multiples, particularly across country, where there's different accounting standards. Where I think it was Redbubble's top line was just their GMV, so like what's the customer paid for a product, whereas Etsy, I think they were subtracting like the portion that they paid to their distributors or manufacturers or whatever. So there's differences in gross margin percentage just from the accounting treatment. So I don't know. I struggle with some of these things a little bit, but yeah, if you can run these little screens and it smacks you over the head, that's kind of interesting, right?
yeah. I think if you're using any multiple in comparison to other companies, the businesses need to be almost exactly identical. Otherwise, it's completely pointless.
Yeah,
When I'm using EV to sales, I'm kind of just looking more generally. What do I think this company should sell for? What has it sold for in the past? How much has it changed? What's the general trend of it? Just to get a rough idea. But for the Redbubble Etsy example, I think he goes towards a more enterprise value to gross profit, which is
yeah,
a multiple that not many people really actually use, but you kind of have to with those businesses because they are very similar businesses in what they do. So it's worth comparing. But um, what each company incorporates into their sales is different. So I think Redbubble incorporates what their artists make on their
yeah,
websites as well. So you can't compare EV to sales multiples because their sales is kind of boosted by that.
yeah. They
So you've got to
look
kick out down to that gross
Yeah, they
profit
look like
line.
a way lower gross margin than Etsy or something because of that accounting treatment. Eh? But that all
Yeah.
comes out on
So
the wash when it hits gross profit.
yeah. So I think that's a problem some people run into, and I've definitely done it in the past when comparing companies on a multiple basis. That's like a very important aspect to consider is how similar are these businesses? what are their operations, how similar are their margins, and everything like that. Otherwise, you may as well just throw it out the window. Jumping back into Alibaba, though, just a little bit
Sure.
more, I want to think about how you are valuing Alibaba. Do you do a typical discounted cash flow? Because there's a couple of ways you could value any company, I guess. You could go through a multiple comparison. You could do a sum of the parts valuation, which sometimes works for these larger companies that have lots of different parts to their business, I guess. It's hard with Alibaba because they have so many different parts, all these tiny moving smaller businesses that you probably don't even know the name of. But then if you go to a discounted cash flow, their future cash flows are very hard to predict how they're going to grow right now with the margin pressures, tax increases, extra competition, all of those things. So how do you value a company like Alibaba at the moment?
Yeah, if I felt like I could do it with any degree of confidence, I probably would go for like a sum of the parts type approach. Because you got an e-commerce business, you got a cloud business, you got the Ant Financial stake, you've got a million other subsidiaries that I probably haven't even couldn't probably even tell you the name of half of them. Um, so I think that would make the most sense because take the cloud business for example. If you look at an overall Alibaba basis and you look at the earnings coming out the bottom, it's effectively like for all intents and purposes, it's basically all just from the e-commerce business right now because the cloud is only just reaching profitability. But if that were kind of spun out to be its own entity, that would clearly have quite a lot of value, right? So I think some of the parts from that aspect make sense. It's just I don't think I'm smart enough to do it. So um, I kind of keep it basic and just do a discounted cash flow. And I really have focused almost exclusively on the e-commerce business, looking at I think their 2030 something targets of 2 billion annual active customers and kind of extrapolating out what I think the average spend per customer is likely to be. And I was sort of landing on low to mid-teen compounded growth rates in the e-commerce business. So I basically just ran that through a DCF, used a pretty conservative like exit multiple, and yeah, depends what growth rates and stuff exactly you use and what free cash flow you're trying to project forward. But I think I was landing in sort of over 250 in ADR, I think, just from the e-commerce business. Um, and then you sort of get cloud and the Ant Group stake and so on kind of for free on top is kind of how I viewed it. I'm sure as I learn more about the business and get a more kind of nuanced understanding of all those different aspects of Alibaba, I can refine those things. But that's kind of where I'm at with it right now.
Yeah, it gets particularly tricky. Like, so the sum of the parts valuation I kind of did for Alibaba, I really only split the business into a few parts. The first one being e commerce, which is, again, the bulk of the business. Then you have the cloud business. And part of the reason I want to do some of the parts is because I think the Alibaba cloud business is going to be the future. At least 30 to 40% of this business in the very near future. At the moment, looking at something like revenue, for example, it's only about somewhere between that 5 to 10% range. But I think that's going to increase very soon. And if you look at other cloud businesses around the world, like the general analyst looking at Amazon and breaking down some of the parts for AWS would be applying probably around a 15, sometimes even more EV to sales multiple in that cloud business. Which, if you do that for Alibaba, if you assume it could be as good as AWS, probably isn't going to be that great, but it's rounded down to a 10 even. Then the valuation for Alibaba, the cloud business in particular, is just, it becomes incredible the more we move forward. So that's part of the reason that I do the sum of the parts. Then I include the other business, which is really all the other little moving parts, the media and entertainment, that really you could just put at zero if you wanted to. And then you have to put some kind of price on Ant Financial, which is hard to do after all the changes that happened in the past year or two. But I kind of put that really low at about $10 billion for their one third stake, which I think is about as conservative as you could get on that
It
one.
used to be 10
Some people
times
would
that, I
argue
think.
it's worth, yeah, exactly. So it's I kind of just go the conservative route there for some of the parts. And then that way you can kind of extrapolate out into the future as well and look at the multiples they'll be worth. So
Yeah.
that's kind of how I more recently valued the company, but I think it's worth doing discounted cash flows and everything else as well and just taking it all into consideration.
Yeah, I think the cloud business is super interesting. I just while you're talking there pulled up some AWS growth rates, and it seems like Amazon Web Services is still growing in sort of the 30% a year type range year over year. I think we saw some mid 30% numbers out of Alibaba Cloud, but it has been a little higher than that. They've lost, I think, ByteDance in the last couple of quarters, right? So that's kind of pulled the growth back a little bit. Um, yeah, I don't know. Like Alibaba Cloud is sort of leading the cloud race in China at the moment, but I'm I'm not as confident about them being them definitely going to be the winner as I am with something like Amazon's AWS. Like I'm not a software engineer or developer or anything like that, but I work in a company that uses Microsoft Azure. Um, we work with a development shop who um, experts in kind of AWS, and it's just interesting to see like once developers and so on get specialized in AWS, how much like more stuff, new stuff they need to learn to come over to the Microsoft platforms and stuff. And you do sort of get ingrained in each of these cloud platforms. And I think the US is much further down that track to where AWS is clearly dominant. And I'm fingers crossed that Alibaba Cloud gets to that same point, and they're in the lead so far. But yeah, whether it deserves the same sort of multiples as a AWS, I don't know. Maybe I'm a little bit less certain about its dominance, but it's also growing faster, so maybe those two sort of offset each other.
So I guess I like the way you're looking at it in the sense that you're really only valuing the e-commerce business. And then if that's undervalued and you get the cloud business for free, that's the exceptional upside you could really get from this business. Because if it does become even half of what AWS is, then that's just an extreme amount of value for the
Yeah,
business.
and I think even the way I've done the e-commerce business valuation is reasonably conservative because you've got businesses. I mean, cloud's just getting to profitability, but there's other businesses that are losing money, which kind of pulls down earnings a little bit. So I may even be understating the e-commerce business value potentially, but you've also got margin pressure and so on. So again, maybe these things kind of just offset each other. But I think the margin of safety is large enough to where, um, yeah, um, it's definitely more than the current price. I guess is kind of where I've arrived at.
All right, one more question before I might wrap this up. We're just over an hour now. I've been kind of interested in people's hurdle rates and what they're trying to get through in their investment at the moment. I've kind of been considering upping my hurdle rate. The way I've thought about it in the past is I'm targeting a 15% annual return. If I think a company can do that, that's when I'm kind of getting more willing to make the investment, assuming everything else about the business is great as well and it's sustainable and all of those things. But I kind of thought of that as a margin of safety to guarantee me at least a 10% return. If I'm wrong in my prediction of a 15% return, I have that margin of safety to get me what I really want over the long term, which is 10%. I think I might be lowballing there, and there might be some validity into upping that and aiming higher. I'm curious to how you think about hurdle rates in general and what kind of gets you over the hurdle there to make the investment.
Um, yeah, I think you've probably thought about this one a lot more than me, to be perfectly honest. I still have the I still have the disease that is wanting to buy 50-cent dollars, and hurdle rates and so on don't match quite as nicely, I would say, to those types of investments. It's sort of like it's like the T-shirt, right? It's compound 26. Like,
26.
is this gonna go back in 3 years or 5 years? In
Maybe I
which
need
case,
to
it's
up it to
15%. Or
26. 26 might be the lucky number.
yeah, and then it's like then it's like, okay, do you discount at 10%, but also add a 50% margin of safety, which I don't know the maths off the top of my head, but that probably gets you close to 20% discount rate kind of equivalents or something like that. And yeah, I don't know if you push that to 15% and also have a 50% margin of safety, you're suddenly probably getting into compound 26 type territory. So um, I don't know. I've sort of always said if I can find one to two interesting ideas and it smacks me over the head, probably that's sort of good enough. I don't try to get too much more quantitative about these things than that. yeah, I don't know if that answers your question at all, but these are the thoughts that flow through my brain.
No, that's perfect. It's a confusing topic to kind of think about, like to really know what sets you over the line to make that investment, because every company is so different, every thesis is so different, so it's really hard to know and have something kind of set in stone anyway. I think it might be worth making it more flexible and not having something so set in stone anyway.
Yeah, and then you sort of get back to like the whole selling discussion. Like you're sitting there with KPG, which has run up a lot. Um, at one point it's come back a bit now, but I think at one point Thor was like $150 a share after buying it at 63 or 64 or something. And I'm sort of sitting there like, is it time to sell and allocate that elsewhere? But yeah, how do hurdle rates sort of fit into that? And then you've got this whole thing in the back of my head of maybe I'm just getting too quantitative about this. And I've got Monish in the back of my ear saying, the mistress always looks hotter than the wife, but the wife is usually hotter. I know Thor a lot better than I do some other company I just read a Value Investors Club write up on yesterday. So, um, yeah, I think over time I've maybe become a little less mathematical about these things and, tried to take the more Buffety sort of approach of if something makes sense, relative to the available opportunities, we take a swing at it. And if it doesn't, you kind of just sit back and let the cash stack up until you find something else that's interesting.
All right, we might wrap it up there with the good old Monish mistress is hotter than the wife quote. That's a
Need to put that on a t-shirt as well.
good, that's a good way to wrap it up. Thanks so much for being the first guest on the podcast, Tom. I really appreciate it.
Thanks for inviting me on. It was an honor.